Welcome to this Killick Explains video, and welcome to the third and final video in my Investing Catchphrases series. So for anyone who missed the first two, there is a part 1 and a part 2. Those contain 5 of these catchphrases each. Here are the final 5. And just a reminder, what we're doing here is saying, what are these catchphrases? What are they trying to say? And how useful are they in practical terms? Because you all come across them all over the place, in books, in newspapers, on computer screens, and so on. So let's start with one that I actually do really like, because people who've seen my previous 2 videos might say you're a bit cynical. Cash is king. Now, basically, in company investing terms, what we're saying is, as an investor, all right, yes, most people just worry about whether share prices are going to go up or down, okay, but you've got to be careful to make sure that you're not caught in what's called a liquidity trap. And this can affect companies just as it can affect individual investors. In other words, as an investor, so as a company or as an investor, make sure you've got a cash buffer. All right. In other words, as an investor, make sure that you are in a position to deal with emergencies. Make sure you're in a position to take advantage of cheap investing opportunities as and when they come up. Make sure, in other words, you've set aside a rainy day fund. Make sure you've provided for what we call foreseeable calls on capital, and make sure when you're looking at a company, all right, looking to invest in a firm, you can see revenue being converted into profit and being converted into cash. Because without that reassurance, you are investing potentially on someone else's promise of future profit and cash flows. I prefer to actually see those profits and cash flows. So both for you as an individual investor and for the companies that potentially you might be investing in, I would tend to agree. Cash is ultimately very, very important. Number 2, you'll never go broke taking a profit. Now, what that's saying is that the problem with shares is this. If and when they go up, they can go down as well as up, of course, as regulators make us say, which is fine. But when they go up, it's all very well saying, I feel a lot wealthier. You flick your app open and go, look how much it's gone up. But remember, until you actually sell those shares, you're looking at a book profit, an unrealized profit. So this is basically saying, if you sell, convert that profit to cash, fantastic. Then you're unlikely to hit a liquidity crisis or a financial problem. But there's a flip side. I mean, it is true, but it's quite a rigid system. You know, I've come across people who have basically, and I've done it in the past, said, once a stock goes up 50%, I'm going to take the profit off the table, have done with it. 50% is a great gain, but my goodness, if I'd hung on to Google in the early days for a lot longer than I did, took my profit off the table, I'd have made quite a bit more. In other words, it can stop people running winners, taking advantage of momentum. It can also introduce too much churn into a portfolio. You know, mechanically, you just sell at a particular level of profits, and it can encourage short-termism, which is not something long-term investors should be thinking about, right? So yes, you'll never go broke taking a profit, but as a long-term investor, how often do you need to take a profit? And that's my point. Next, don't fall in love with a stock. Now, passion in investing does matter. It's important that people commit to the market. When I'm talking to young people, for example, you know, I get them to names they've heard of, brands they can get on board with. And if that's enough to get them into investing, so be it. You know, that enthusiasm does matter, all right? And if as a bonus, the brand they're looking at is profitable, generates cash flow, has a sustainable competitive advantage, as I call it, so much the better. But be careful. It's not enough to just buy popular stocks, because by definition, popular stocks tend to be expensive. And it's not really enough to just buy what you've heard of these days, because what I can mean is people stick to, say, the UK market when they could be doing a lot better investing overseas in, say, the US market. So don't be constrained by solely investing in things that you've heard of and are passionate about, but by all means do fall a little bit in love with the stocks that you own, up to the point where you actually take an interest in them, actually try to get to grips with what they do, how they make money. That's fine. Just make sure that when the time comes, you are potentially ready to change course if and when the facts change, or if and when something material alters in terms of that stock's prospects. Next, what is comfortable is rarely profitable. This is about not staying in your comfort zone as an investor, all right? It's basically saying that it's very easy to pick up the well-known, popular stocks, the more exciting stocks in the market, if you like, the latest technology, the latest innovative stocks, the latest AI play, all right? But they can be expensive, okay? And you may be missing out on what I call the unsexy sectors, the unsexy stocks, all right? The bottom line is people tend to herd into things that look exciting and attractive, and they often ignore, the fairly boring, steady sectors that actually are quietly pretty profitable. The trick, therefore, is to diversify, okay? Not overdo it on either the exciting or the boring side of your portfolio, if you like. And it's all about making sure that as an investor looking to sort of succeed, you stick to some core principles. So dedicate enough time to building up enough knowledge, all right, understanding the risk tolerance you're prepared to accept, and committing to enough time in the market. Which brings me to my final and fifth catchphrase, if you like, which is time in the market is more important than timing the market. And the bottom line here is this is one of the most important ones for a long-term investor. Market timing is tough. There are too many people out there trying to make a quick buck. There are too many algorithms, too many professional traders, too many other retail investors, all trying to beat the market. All right. Worse than that, the people that you will see on TV, in magazine articles and so on that have done it are survivors. They're the 1%, if you want to see it that way. What you don't see is all the people that tried to beat the market and failed, right? Because they're not as interesting in media terms or social media terms. So be careful. Stick to a long-term strategy, all right? Make sure you understand your tolerance for risk, all right? Make sure you understand the sort of return profile that will come with that tolerance for risk you're building out a portfolio. Keep your eye on the long term, all right? Don't be too tempted to alter course dramatically in the short term just because you've suddenly heard about AI stocks, for argument's sake. And keep your reviews of your portfolio positioning systematic, all right? Obviously, you're not going to necessarily run the same portfolio for decades, all right? There will be adjustments you make along the way, but try and be systematic in making them. Overall, what we're aiming to do is something that Terry Smith, famous fund investor, describes as a three-prong approach. Buy good stocks, don't pay too much for them, and then ideally do as little as possible. Okay, so that's my final 5 famous catchphrases, if you like. Hope you found that series useful. Don't forget parts 1 and part 2 preceded this video. Find out more about this topic and lots of other ones. Killik.com/resources contains Killik Explains videos. It also contains a link to the quarterly magazine Confidant that has lots of equity sections in it usually. And you could also grab a copy of my how-to guide on investing in equities.